Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about non-registered investment accounts, and this comes straight from a client that we were doing a financial plan with, and he had a few questions, or they had a few questions around, non-registered accounts, how to structure them. They had one in place already that had a big gain on it that was held single life. Should they take some of the other cash they have and do joint life? So let's walk through that process. I think a lot of you, again, fall into this situation. It's a common situation of, do we do joint accounts, individual accounts? What are the benefits? What aren't they? And a lot of us kind of look at the surface level stuff, but we dig into the retirement planning, the tax planning. How does that how is that affected down the road? So let's jump into that. If you're not already subscribed to the channel, hit the subscribe button below. It takes 1 second. It costs you nothing. We release videos every week, 2 every week. In September, we'll jump to 3. And we just put videos out on financial, retirement, estate, and tax planning for Canadians, whether you live in Canada or abroad. So let's jump into a bit of a situation. You have a bucket of money. It could be from a sale of a property. It could be an inheritance. It could be just money that you've saved up over time. What do you do with that money? So we're assuming that you're married or common law partner. So you could have a joint account essentially. So for single people out there, build up that non-registered account if that's the best option for you. Again, you've used your RRSP TFSA in this situation or any situation here, and you have this cash. Like, what to do with that? If you're single, obviously you build a non-registered account, build it up. It's going to be taxable to you, but it's still a great way to do it. So, but let's jump into, if you're married or common law, this video is more around that, around some tax planning around. Do you do the account, in individual names, or do you do a joint non-registered investment account? So when we look at a joint non-registered investment account, the biggest benefit is that when one spouse or common law partner passes away, that money goes to the other person without any tax bill being due, okay? So it just defaults to the other person, okay? So the ownership of the account, if you're both on there, one of you pass away, the other person just continues with ownership of that, okay? If there's a big taxable gain in that account, no tax bill is due, okay? It's not due until second death, okay? So that's obviously a huge benefit. You put $100,000 in there and fast forward 30 years, and so we're $300,000, there's a $200,000 capital gain in there. We want to make sure that, that on first death, no tax due, second death, tax would be due, but the account could be liquidated at that point. The other big benefit with doing the joint account, and this really comes into tax planning in retirement, but also leading up to retirement, okay? So this is where we see people either do joint or single life, okay? So if you have a joint non-registered account, any income that you earn in there every year is split tax-wise, okay? So what we see is in retirement, it's nice to have that split tax, but what we find is leading up to retirement, a lot of people will set up, the investment account, say it's from an inheritance or sell property, whatever it is, under the lower income earner. And that makes a whole lot of sense because any of the income that's earned in that non-registered account is taxed back to the lower income earner, right? It could be at a 0 tax rate. Now, you have to be careful from attribution rules, okay? So attribution rules is, the high income earners made money, given that essentially to the low income earner to invest and make more money on. Be careful, CRA would catch you or could catch you on the attribution rules. So be aware of that. Lots of videos out there on that, but be aware of that. But if it's money that, that person's made or whatever it is, if it makes sense, if it falls within the rules where the person can create a single life investment account and have that taxable income go to them, it makes a lot of sense. On the joint side, if you're able to split that income, especially as you head into retirement, it makes a lot of sense as well. So again, just to summarize there, I know we kind of went all over the place, but a joint investment account is beneficial because you can split that income, okay? So if you make $1,000 a year in that account, it's only $500 to each of you, and potentially less if there's some capital gains there. So keep that in mind. Joint investment account makes a lot of sense because you can split that income. Now, the downside to a joint investment account, there's 2 of them. First off is the split income, okay? So if you're still working, you're leading up to retirement, and you take 2 spouses, and one is a high income earner, one's a low income earner, and you need to split that income, some of that income is going to be taxed at a very high marginal tax rate, and one at a very low tax rate. It's not a very tax efficient process, okay? So that's one downside. The other would be marital breakdown, okay? So if there's a marriage breakdown and there's a joint investment account and there's a large gain, you have to factor that in. Potentially the account might have to be sold, which would trigger taxes, or you have to somehow calculate that into, when you split your assets And keep in mind that there's a gain there, there's some tax to be due. It just becomes a bit more convoluted. So those would be the two downsides of creating a joint investment account, where we see a bit of a red flag and potential, reason for not doing it as a joint account. So when we look at a single life investment account, so someone, it's under one person's name, not both people's name, there's some benefits to this. So there's some flexibility on when you take that money out to allocate that income to one person. So in retirement, and this fell into the plan that we were doing for this couple, okay? So one of them had an investment account under their own name, and they had quite a large gain on it, and that was the high income earner. And the other person didn't have any, okay? So what happened is in retirement, and they were retiring early at 55, is as we pull money out of there, it was taxable only to the husband. We couldn't allocate that to the wife. That creates an issue, and there's quite a substantial taxable gain in there. So this is the one downfall of that. But on the flip side, you could do some planning where they have some money that could be allocated to her. It's her money. Set up an investment account with the additional cash that they have in just her name. And what that would allow us to do is allow that account to grow, and down the road pull it out so it's taxable just in her name. We don't need to split that income. Okay, so just be aware of that. It's especially important if you retire before 65 or before you start some pension money. Okay, so be aware of what type of income you can split in retirement. Okay, RRSP money, when you convert it to a RIF, you can only do income splitting in retirement with that money at 65 on. So if a lot of your money is in an RRSP and you need to split some income before that, or get more money or income allocated to the lower income earner before retirement, then a single life individual investment account might be a good option. Again, be aware of attribution rules. That always comes into play here, but maybe build up that non-registered under the lower income earner. So if you retire at 55 and have to start pulling money from your RRSP, which you cannot split the income from, at least the lower income earner has this non-registered account they can pull money from, and any taxable bill from there is only taxed in their hand. So it helps kind of level out that tax bill in early retirement. So I just want to give my personal feedback. So not a tax feedback, but personal feedback. We would always recommend to do a joint non-registered account, okay? Unless there's something that's really guiding us to do the single life, which isn't usually the case, we will almost 99% of the time do a joint investment account. It creates more flexibility. Yes, you have to split that income, so there might be a bit of a lopsided tax perspective leading up to retirement or early into retirement if you don't have split income options. But doing that down the road just allows, again, if one spouse passed away earlier, the other person continues on, there could be a large gain in there, could save a lot of tax. Again, a lot of that tax bill we can even out over the years. If it's in a single life and that person dies, you're paying a whole lot of tax in 1 year, which isn't beneficial. So again, just leveling off tax, splitting the income, it creates more flexibility. So if you're sitting there with some money and you have the option to do a joint investment account with your spouse or common law partner, and it makes sense for you, it probably is the best route to go, okay? Unless something, you put a plan together and 100% it makes sense to do a single life, the majority of the time we recommend doing a combined or joint life investment account. Just create some nice flexibility, protects for if one of you passed away early, and does allow for that income splitting in retirement. So if you're sitting there on sidelines, that's the best way to structure the joint non-registered account moving forward. So thanks for joining us in this video today. Again, we've run into this actually quite a bit the last month or so. That's why we wanted to release this video. I think it's actually more common than I thought it was. So if you're sitting there with some cash, you're not sure single life, joint life, how this works, or maybe you have an investment account already, and it's single life and you're kind of looking ahead saying, should this be joint or not? You might want to structure a joint. The client we were working with yesterday, again, he had a single life one with a large gain in it, and that money was actually earned joint, so they could have set it up as a joint investment account originally, been able to split that income now, would have been much more fluid for them. So if you're planning ahead, think about that joint life if it's an option for you. So thanks for joining us in this video. Hopefully the background noise, we have a construction site, right behind us here. They're building a new development. I try to do my videos before 7 a.m. so that noise doesn't start. But anyway, we got a bit late today. So anyway, I hope you enjoyed the video today. If you did, hit the subscribe button, hit the like button, make a comment below if you have any questions, concerns, and we'll see you in the next video.